I've got some big news, people. There is a brand new tax break worth up to $2,000 in the new big, beautiful bill signed into law by President Trump. Most people have no idea this exists yet, but if you give money to charity, this could be huge for you. We're going to break down exactly what this new rule means, how much you can save, and the smart strategy that could double your tax savings if you time it right. This is different from anything we've seen before. So let's dive right in with Chapter 1. What is this new tax break? The new tax break is all about charitable giving, but here's what makes it special. For the first time ever, you can get a tax deduction for charity donations even if you don't itemize your taxes. Let me explain what that means. When you file your taxes, you have two choices. You can take the standard deduction, or you can itemize your deductions. The standard deduction is easier. Most people use it. About 90% of people take the standard deduction according to the IRS. But here's the problem. If you take the standard deduction, you normally can't get any tax benefit for giving money to charity. That's been the rule forever. Until now. Starting in 2026, there's a brand new charitable deduction. This works even if you take the standard deduction. You can have both. The standard deduction plus this new charitable deduction on top. The deduction only works for cash gifts though. So if you donate clothes or furniture, that doesn't count. It has to be actual money you give to qualified charities. This is similar to something we had during COVID. Back then, you could deduct up to $300 if you were single, or $600 if you were married. About 48 million people used that deduction in 2021, but this new version is much bigger and it's permanent. Now let's talk about Chapter 2, how much money you can save. But really quick before I move on, if we haven't met yet, I'm Sean's clone, a licensed tax professional who personally researches and writes every script you see from me. And while Sean is helping people save on taxes, I'm here to share his knowledge with you. But if you have any questions, the real Sean reads every single comment and tries to respond to most. Also, if you need help with tax planning, click the link below to get a free consultation to start saving more money before the tax year ends. All right, on to Chapter 2. How much money you can save. The amounts for this new deduction are significant. If you're single, you can deduct up to $1,000 in charitable donations. If you're married filing jointly, you can deduct up to $2,000. But here's what really matters. How much money does that actually put back in your pocket? The answer depends on your tax bracket. Let's say you're single and in the 22% tax bracket. If you donate $1,000 to charity, you get a $1,000 deduction. That saves you $220 on your taxes. That's 22% of $1,000. If you're married and in the same 22% bracket, you could donate $2,000. Your tax savings would be $440. For someone in the 12% tax bracket, the savings are smaller but still meaningful. A single person would save $120. A married couple would save $240. Even if you're in the lowest 10% tax bracket, you're still looking at real money. $100 for singles, $200 for married couples. The key point is this. Every dollar you were planning to give to charity anyway now reduces your tax bill. That's money you get to keep that you wouldn't have kept before. But there's a smart strategy that could help you maximize these savings. And that's what we need to talk about next. Chapter 3, the smart timing strategy. Here's where things get interesting. This new deduction doesn't start until 2026. So if you're planning to make charitable donations, the timing of when you give could matter a lot. Let's say you normally give $500 to your favorite charity at the end of each year. You were planning to give $500 in December 2025, then another $500 in December 2026. But here's the smarter approach. Instead of giving $500 in 2025, wait until January 2026, then give $1,000 all at once. Why does this work better? In 2025, if you take the standard deduction, that $500 donation gives you zero tax benefit. But in 2026, that same $500 becomes part of your new charitable deduction. So by waiting just 1 month, you turn a donation with no tax benefit into a donation that reduces your taxes. This strategy works best for smaller donations. If you're already itemizing your deductions, you're probably getting tax benefits from your charitable giving already. But most people aren't itemizing. Most people are taking the standard deduction and getting no tax benefit from their donations. You're making the same donation you were going to make anyway. You're just shifting the timing by a few weeks to capture a tax benefit you wouldn't get otherwise. Of course, you should only do this if it fits your overall financial plan. Don't change your giving strategy just for taxes. But if you have flexibility in timing, this simple shift could save you money. Now, if you decide to use this new deduction, there are some important rules about keeping records. Let's cover those next. Chapter 4, record keeping rules you must follow. The IRS is very strict about charitable deduction records. If you can't prove your donation, you lose the deduction completely. Even with this new rule, the record-keeping requirements stay the same. For any donation of any amount, you need proof. This can be a bank record showing the payment, or it can be a written receipt from the charity. The receipt needs to show three things: the name of the charity, the amount you donated, and the date you made the donation. But if you donate $250 or more, the rules get stricter. You need what's called a contemporaneous written acknowledgement. That's a fancy name for a special letter from the charity. This letter needs to include more details. It needs to confirm the amount you donated. It needs to state whether you received anything in return for your donation. If you did get something back, like a dinner or a tote bag, the letter needs to say what the value of that item was. The timing of this letter is critical. You must have the letter before you file your tax return or before your return's due date, including extensions, whichever comes first. Here's the scary part. If the IRS audits you and you don't have this letter, you cannot fix the problem later. Even if you really did make the donation, you lose the deduction completely. Justin Miller from Evercore Wealth Management warns that many taxpayers mess this up. They make legitimate donations but don't keep proper records. Then they get audited and lose deductions they should have been able to keep. So here's what you need to do. Every time you make a charitable donation, ask for a receipt right away. If it's $250 or more, specifically asking for the contemporaneous written acknowledgement. Don't wait. Get it immediately. Keep all these records in a safe place. A folder on your computer works fine, or a physical folder in your filing cabinet. Just make sure you can find them when tax time comes. Following these record-keeping rules protects you from problems later, and it ensures you can actually claim the tax benefits you're entitled to. The bottom line is this new charitable deduction is a real opportunity to save money on your taxes, but you need to plan ahead to make the most of it. First, figure out if this applies to you. If you take the standard deduction and you give money to charity, this new rule will probably help you. Starting in 2026, you can deduct up to $1,000 as a single person or $2,000 if you're married. Second, consider your timing. If you're planning smaller charitable gifts for late 2025, think about waiting until early to 2026 instead. This simple timing shift could turn a donation with no tax benefit into one that reduces your tax bill. Third, get your record-keeping system ready now. Every donation needs proper documentation. Donations of $250 or more need special acknowledgement letters from the charity. Start asking for these letters every time you donate. Finally, talk to a tax professional if your situation is complex. If you own a business or an investor, click the link below for a referral. Now remember, this new tax break won't make you rich overnight, but it's free money for something you were probably going to do anyway. And in today's economy, every bit of tax savings helps put more money back in your pocket where it belongs.